So we are getting retail numbers for Canada. It looks like June in line with consensus, but July pointing to an increase of 0.4%. So a sign of strength there for the Canadian consumer. Let's digest those numbers and lots of other ones with Karl Schamotta, Chief Market Strategist at Corpay. It's great to see you.
You as well.
Just give us your take on Canadian retail sales. Has the Canadian consumer gone into retreat?
Not yet. It does look like consumers, households in general, are sort of running on fumes at this point. We know that, disposable income gains have slowed pretty dramatically, that they're cutting into savings, but they're still spending quite a bit of money. The one thing here that sort of worrisome in the June report is that we did see an ex-auto decline. So, households spending outside of spending on autos declined quite sharply, while at the same time, the July preliminary estimate is pointing to continued robustness and, in fact, a rebound in spending. So that's I think, the first big rebound in 4 months in Canadian retail spending. And all of that, suggests that the Bank of Canada's job in bringing down excess demand in the Canadian economy is not yet mission accomplished. I certainly wouldn't suggest that we're looking at a rate hike anytime soon, but at the same time, this is a sign that just like the Fed, the Bank of Canada is going to have to remain alert for a rebound in that consumer spending side of the economy.
You don't think that we're looking at another imminent rate rise from the Bank of Canada?
No, I think when we look at the softness that we're seeing elsewhere, so in employment overall, when we look at sort of the below the hood details in the economy, I think there's a lot of reason for caution there. And the Bank of Canada is going to, sort of weigh that side of it more heavily than they're looking at the inflation side. All that said, they're going to remain relatively hawkish in terms of the rhetoric. I don't expect them to, sort of have that big moment where they come out and say that inflation has been vanquished and that they no longer have anything to worry about. They're going to maintain that sort of telegraphing to markets that another rate hike is possible in the autumn months.
What about the United States? Actually, explain this to me as a long-term observer of interest rates. The American 30-year mortgage rate now reportedly around 7.5%.
Right.
I mean, that's a long time to be borrowing money at that rate.
Yes.
Why are interest rates going up so much?
Right. So I think there has been a capitulation, right? I think markets in general have suddenly realized, that the inflation pressures in the economy are actually stronger than they were prior to the pandemic. They're also looking at a flood of issuance from the U.S. as well as virtually every other sovereign, in the world.
Bonds, just printing up bonds.
Exactly, lots and lots of printing. And so what's sort of interesting in the last couple of weeks is that it might be somewhat technical in nature, right? We might have had a situation where all of this supply was coming into markets that were relatively thin, and that pushed, yields up a bit. All that said, the fascinating thing when you look at the U.S. right now is that firstly, of course, prices have not really moved. In fact, they're still marching up across the U.S. Home prices are still marching up. And if you look at that sort of big peak in rates that we're seeing, it is not that high in real terms. We've just recently popped back into positive territory in real terms. And so, the key here is that, for most of this year, homeowners have been borrowing, taking out a mortgage against an asset that is appreciating, and they're paying less than the rate of inflation. So when you take all of that together, it was a big tailwind for the housing market, even as, I think most of us were looking at that nominal rate and expecting a shift in behavior among home buyers.
But explain that to me. I mean, if the mortgage rate has gone 30-year, gone north of 7% in America, I mean, inflation is nothing like 7%.
No, not anymore. It has moved up, on a sustained basis in the last couple of weeks. But when you look at where break-evens are relative to the interest rate itself, then you're looking at, just narrowly moving into real territory. And so, I think the key here is that when you're looking at an economy that is generating that inflation for virtually everything else, it makes sense to buy an asset that will appreciate with it, right? And so I'm not saying that there wasn't a headwind for more buyers. There certainly was, and we've seen a huge decline in the number of listings coming out. We've seen a big decline in the number of buyers coming in to purchase homes, but prices have remained relatively stable. And so, it's sort of...
Sorry, Karl, you're talking about U.S. and Canada?
The U.S. and Canada, actually,
okay,
yeah.
Sorry.
I was talking really specifically about the U.S.,
Okay.
but the funny thing is we have very much seen the same dynamic here in Canada, right? It's probably something that no one had on their bingo card at the beginning of the year, right? This idea that that high interest rates might actually keep prices elevated because no one wants to list their home and no one wants to move to a new mortgage.
That's interesting. So stickiness in that asset class. People
Yes.
don't want to renew a mortgage at high rates.
They wouldn't. It makes sense to hold on where you are. I think this is terrible for the economy in the short run, especially because that means we have lower labor mobility, right? Like if you're not going to move to take a new job, if we're going to all stay put in our homes and sort of maintain the mortgage rates that we have, that's bad for the economy. But in the short run, the fascinating thing is that we have seen that sort of, that demand and supply imbalance actually widen in a way that I don't think anyone actually predicted, January of this year. I think virtually everyone, myself included, got it wrong. We all thought...
On home prices.
Yes. We all thought that this higher borrowing cost would slow the pace of activity, drive prices down, and that would impact overall consumption in the Canadian economy. And that just has not transpired. Maybe it'll come soon, but it has not happened yet.
Jay Powell expected to speak Friday morning.
Yes.
And what signals should investors look for?
Well, that's a fascinating thing here, too, because this is sort of like Donald Rumsfeld saying that, that there are known unknowns. The reality here is very few market participants are taking a big position going into this, right? We just don't know what he's going to say. He could remain largely theoretical. He could follow Yellen and some of his predecessors in talking about the neutral rate of interest and focusing specifically on structural changes in the economy, which is what the conference is about. If he does that, the market implications might be relatively minimal. On the other hand, he could steer markets in a relatively hawkish direction by emphasizing that the Fed plans to keep rates higher for longer. Now, that's going to be relatively interesting in terms of how it hits the market because, 2 years ago, he was telling us that inflation was going to be over quickly. A year before that, he was telling us interest rates are going to remain very, very low for a very long time. Yeah. And so, there's a bit of a credibility gap. Yeah. And then very lastly, there is a dovish possibility here, and that is that he comes out and says, that we have seen growing evidence of disinflationary forces in the U.S. economy, and that should, negate the need for immediate rate hikes. Like, in other words, he might set the table for a prolonged pause. If he does that, markets could rally pretty substantially on the back of his comments.
I'm trying to think of a structural change we've seen in the U.S. economy. This labor tightness, I don't know, is that a transient thing?
No, I don't think that's super transient. I do think that, your demographic forces are contributing to that. If you look at the structural forces overall globally, right, we have, sort of that demographic issue. We have demand. We have the fact that consumers are aging and they're moving into the phase of their lives where they spend more than they earn. All of that is sort of subtracting from the availability of global capital. It's also, sort of reversing that dynamic that we saw after the global financial crisis, in which demand remained way too low for way too long. And so, I think Fed policymakers, John Williams in particular, think that we are going to see a reversion back to the neutral rate of interest that we saw prior to the pandemic. So they think that, these structural changes are there, but they're not that big. That seems to be the intellectual leadership they're putting out there. But there are, naysayers. There are certainly people, especially in the markets, who think that we have seen a fundamental shift, especially with deglobalization happening, right? This, the fact that we're not able to move people, goods, money, ideas across borders as quickly as we were prior to the pandemic and prior to, perhaps the rise of the populace. All of that impacts the long-term inflation picture, and it impacts where monetary policy settings need to be.